Hi, I'm Jay Woods of Freedom Capital Markets, live from the New York Stock Exchange. The sound of that bell means one thing. It's time for the final bar.
Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the power of the StockCharts platform. StockCharts was created about 25 years ago to empower individual investors, financial advisors, and all market professionals to better understand the markets by focusing on the message the markets provide back to us, by analyzing price and breadth and sentiment, trend and momentum. All of these tools of the technical analyst, we can better understand what is happening in these markets by quantifying investor psychology, seeing how investors are voting with their capital. A lot of things to unpack. Of course, investing involves a lot of what we call black swan events, things kind of coming out of nowhere that shock the market to the upside, or as we saw today, to the downside. Not a lot of people talking about Fitch downgrading the U.S. this morning, but that's sort of what happened. And all of a sudden, we're left to put the pieces back together, see what this means. A lot of stocks pushing to the downside, growth leading the way downwards, and this is pushing FANG stocks down to that crucial level of potential support, the 50-day moving average. Let's get to all of that and more as we unpack the market action with our market recap. By the way, we asked you recently in a poll, so don't forget to subscribe to our YouTube channel, follow us on Twitter, and you will get our next poll question. We asked you, will August 2023 be a positive or a negative month for the S&P 500? 2 out of every 3 of you said no, it's going to be a negative month. I would vote negative as well, and I think before today happened, I would still say it's probably a negative month. And I would say more than anything, that's a play on seasonality. Talking yesterday with Ari Wald of Oppenheimer, really good conversation. And if you missed that one, make sure you go back and check it out. But we talked about that relationship between the trend in the market and the seasonality. The reality is, in a pre-election year like 2023, there are certain seasonal tendencies. In an average year, August tends to be a pretty rough month. September doesn't tend to be particularly good either. In a pre-election year, those seasonal trends tend to be magnified. Here we're looking at the seasonal chart of the SPY. What percent of months for the last 20 years was August a positive month? And it was 60%, which is actually one of the worst of the 12 months. If you look at a pre-election year, it actually scores a little bit worse. So August doesn't tend to be a great month for stocks. We have what we call the summer doldrums, which tend to play out. And so far, I think that's a reasonable expectation. And given the fact that we've had such an incredible run leading up to August, I think even more sort of puts an exclamation point on the seasonal tendencies that normally have happened over time. So the seasonal headwinds are certainly very much in play. Let's look at what the market did today relative to that seasonal trend. And basically today was all about the Fitch downgrade. Taking the U.S. away from that AAA rating all of a sudden pushes risk assets to the downside. You're going to see that across the board when we look at sector rotation, when we look at benchmarks, and we look at other asset classes as well. Let's unpack these one by one. The S&P finishing lower, about 1.4%. That's putting us around 4513. The Nasdaq composite leading the way lower, and that's around 2.2% to the downside. The Nasdaq composite well below 14,000 now as we finish trading today. Mid caps and small caps down as well. Small caps down the least, though. That might be an interesting data point to pay attention to. 0.9% lower for the S&P 600 small cap compared to the S&P's negative 1.4%. The only green you see on this front page of our market dashboard is the VIX, which went up over 2 points. Yesterday during the show, we're talking about a 14 handle on the VIX and what that might mean. Today, volatility spiking higher. Now, that is what generally happens when you see a big downside move in stocks, is you'll see a spike in volatility. And the way that I would think of it is the general sort of market maxim that the market goes up the escalator but goes down the elevator. So when things get panicky, when people get nervous, when investors start to feel a little unsettled, they don't sort of calmly and patiently go and put in a little bit of sell orders one at a time and let things roll over. They tend to hit sell in a big way, and that's what causes volatility to spike when the market tends to rotate lower. So the VIX now above 16, still well below the historical average that we've seen over the last 18 months, but certainly spiking higher than what we've seen for most of the year 2023. Let's continue on looking at some other asset classes. Bit of a mixed result overall, but 10-year yields continuing to push higher. We talked about the 10-year yield yesterday pushing above 4%, what that might mean, and the prospect of higher rates and how that can negatively influence growth stocks if you look at historical tendencies. 10-year yield up a little bit, currently finishing the day around 4.08. You can see the long bond yield above just almost to 4.2%. The dollar index up about 1/3%, so not a huge move, but certainly continuing to push a little bit to the upside. A lot of red on the page of commodities here. We talked yesterday about commodities and the potential for more value-oriented sectors like materials and industrials to improve. For now, sort of rotating lower. Gold down 0.5%. That's the GLD. The SLV, which is a silver ETF, down 2.4%. Copper prices down as well. Crude oil moving lower. The USO, which is a crude oil ETF, was down 2% today. The energy sector not doing particularly well, but growth sectors certainly pushed even further to the downside. Finally, cryptocurrencies, a bit of a bounce for Bitcoin. Didn't quite get to 30,000, rolling over through the course of the day today. During the equity trading session, remaining sort of at the lower end of the range, down 2%, currently around 29,114. Sectors, by the way, only one of the 11 S&P sectors, really two if you look at it in the green. Consumer staples up about 0.4%. Healthcare and utilities were essentially unchanged for the day. Everything else was down. If you look at the leadership to the downside, it's the FANG sectors, the growth sectors, right? Technology down 2.5%. Communication services down 1.9%, consumer discretionary down 1.8%. So here's the thing, right? If you look at sectors like healthcare and staples and financials, not too bad of a day, kind of flat, a little bit up, a little bit down, not too bad. The problem is, for if you're thinking about the big picture, thinking about the macro environment for equities, they are very much geared toward the growth sectors, right? We have a growth-oriented economy at this point, and certainly a growth-oriented benchmarks. So as a result, when tech, communication services, consumer discretionary, all down 1.8 to 2.5%, our benchmarks have no chance of being anywhere but down in a big way. And that's certainly what we saw today with the Nasdaq leading the way lower. Let's look at a daily chart of the S&P, see what sort of damage we did. Now, what's interesting about this chart is if you tuned in over the last couple weeks, we've been talking about this pattern of accelerated trend lines. And just as a reminder, what happens is when you have an initial rally, so we're taking the October low of last year, the March low from earlier this year, that's that green sort of thicker trend line that you see currently down around 4150. What happened a couple months ago is we started to get away from that trend line. We call this an acceleration, right, where the slope of the market starts to increase. So you have to draw a secondary trend line. The second trend line took the March low and the May low. We drew a second trend line. All of a sudden, the price is getting further away from that. So we have to keep drawing trend lines of increasing slope to match the acceleration in the markets. This is a market that's more, accelerating its trend, accelerating the pace of the incline over time. What you look for is when we finally break one of those trend lines. Today was that day, right? So yesterday we talked about, can we hold that trend line as a tactical read? Can we hold that short-term level of support? Today's the answer is no. So when you have a drop below a key support level, just an initial support level even, it's all about follow-through. Do we get some sort of follow-through tomorrow on Friday's session? Do we see further deterioration telling us that this move today was just the beginning? Or do we get a sort of a reflex rally back above that trend line, which is very much possible? Tomorrow we have some pretty big earnings with Apple, Amazon this week. There's a lot of names reporting that certainly have the opportunity or the potential to push prices back to the upside. But the proof is in the price. For now, we're breaking that initial trend line, which for me immediately makes me think to go to that next trend line, which is right where the 50-day moving average is, right around 4,400. So what's interesting to me is a lot of key stocks like Microsoft breaking down through its 50-day moving average this week. Other growth stocks like Netflix and others sort of testing their 50-day. Does the S&P now test its 50-day as well? It's a little bit below current levels. That's another 100 some points below today's close to get down to that 50-day moving average around 4,400. That might be the next downside objective. I wouldn't be surprised if we get there, if not further in the month of August, but we'll see what actually happens. Now, if you look at the Nasdaq 100, we talked about the Qs yesterday. I just want to highlight with the Nasdaq 100, remember that today's drop down 2.2% certainly seems severe. And again, if you look at the average trading day in 2023, this is a pretty big down move. But let's keep the proper perspective here, right? We're still within a pretty long-term uptrend. I think that was my conversation yesterday with Ari Wald, relating sort of the short-term weakness and the potential for further weakness with the realities of the long-term trend. When you've had a market that's had this quick of a pace and it's had this strong of a rally, you have a lot of daylight below current levels to still be within an uptrend, right? We can still go down a little further and still make a higher low and have a nice uptrend, right? A trend channel starting last October is still well below the current levels if you look at a pullback and what could still be deemed a constructive pattern. One of the things that I immediately am drawn to is looking at Fibonacci retracements. And what that means is basically when you've had a high and you can take it down to a previous low, you sort of set that as the framework for the markets. And what this means is we could go all the way down to the Nasdaq 100 around 14,000, which would take us down to the August 2023 high. Using Fibonacci framework, you can get it down to another, 1,300 points to get down to 14,000 and still be within the context of an uptrend. That would still, from a Fibonacci perspective, be a pretty constructive chart as long as we hold that first Fibonacci level, 31.8%, around 14,000. So the reality is, with the run that we've had with the strength of leadership names like Apple, there's a lot of downside space below current levels to still be long-term constructive, but be plenty short-term weak. And I think that might be what we're seeing right now. Let's continue on looking at a couple other charts here. Wanted to highlight just very quickly the VIX, of course, a big move higher in volatility to 16. Again, looking at a chart of the last couple of years, you can see that even with today's spike of 2 points higher in the VIX, we're still well below the average level we've been in, right? The volatility in 2022 was very elevated, with the VIX ranging between 20 and about 35 on the upper end. In 2023, it's become lower and lower. We're now back sort of in the range of where we were in 2021. The VIX pre-2021, if you're looking sort of like the mid-20 teens, the VIX was down in the lower teens for an extended period of time, and that's what marked that those extended sort of bull market years, sort of the meat of the secular bull market phase, is you have a market rallying on lower volatility. That's been what we've experienced over the last 6 to 8 weeks. Volatility has spiked today, but again, there's a lot further that could be had and still be within sort of that low volatility. I tend to think of a VIX below 20 as sort of a low volatility environment. VIX above 20 is sort of a high volatility environment. So we've got a lot further to go before we even reach the VIX levels that we saw in May. But the more that the VIX spikes higher, the less you should feel confident as a market bull, watching the volatility suggest panic from investors. I did want to highlight one key breadth indicator because we've talked about the bullish percent indexes a number of times, and the bullish percent index basically uses point and figure charts, aggregates a 500 or 100 or whatever universe you're looking at, a group of stocks, and it says what percent of them are in a bullish phase right now. The Nasdaq 100, of course, looking at the 100 members of that growth-oriented index and saying what percent of them are in a bullish phase. We peaked out just around 80% about a month ago in mid-July and then have rotated lower. I've highlighted here in red when the index has been above 70%. It just broke below it. If you look back at when this bullish percent index has been above 70% and then come back below that level, it usually doesn't tend to be a good sign. It usually suggests that there's weakness. An extreme strong breadth reading becomes a weaker breadth reading, and that's what we're starting to see with the Nasdaq 100. This would overall, again, assuming there's not a big mean reversion to the upside tomorrow, overall would suggest a weaker short-term environment for growth-oriented sectors and stocks. Just a couple stocks to figure out to finish off here with earnings. A lot of earnings to unpack. I wish we had time to go through all of these charts and start to think about them. Payment processors down today, along with most stocks, given the environment and sort of the macro headwinds that we saw today. As I mentioned in the introduction, PayPal down 3% today. Payment processors, you think of things like PayPal, Shopify. We'll look at both of those charts here. What's interesting about the chart of PayPal is not today's 3% decline, but that it comes right after PayPal finally got back above the 200-day moving average. If you go back to the fourth quarter of 2022, that's when PayPal actually broke below the 200-day. From there have been numerous times where PayPal has attempted to get above the 200-day and either failed to do it all completely, which was what happened in November of last year, gapped a higher and then saw these bearish candle patterns like you saw in February of this year. And then this week, and in the last couple weeks, we've been bumping up against the 200-day moving average. Certainly seemed like earnings this week could be the catalyst to finally push PayPal above the 200-day. It's not happening. Today, you're actually back below the 200-day. And so stocks like this heading up to resistance and failing to get through them is usually, in my opinion, a good sign of underlying weakness in stocks. This is showing you that the buying power that you'd want to see push a chart like PayPal higher kind of dissipating. Shopify, a little different look to the chart than PayPal, which has been in a pretty consistent decline here. Shopify has actually been in a nice uptrend over the last 8 to 9 months. It reminds me a lot of some of the FANG stocks. And just like Microsoft has failed to hold its 50-day as of today, Shopify down over 7%, breaking down through its 50-day moving average. So similar to PayPal, the idea that when stocks are unable to break through a key resistance level, that can be a market tell of sorts. Stocks like Shopify, instead of holding a 50-day on a pullback to actually break through them, that can be kind of a negative signal as well, telling you that the normal sort of buy on the dips pattern you may expect may not be playing out. Now, let's see if there's a follow-through day tomorrow, and that's important with a lot of these stocks that are testing support and may look like they're breaking through. Today, a lot of the charts are looking weak. My question would be, do they get a follow-through day Thursday, Friday? Do they show that there's additional selling beyond just what we saw today? That could be an important tell for that stock and also for the markets as a whole. That's our market recap for today. And again, so many charts we could get to. I tried to touch on as many as we could. I'm going to bring on today's guest, Jay Woods, here in a moment. Before I do it, just a couple quick announcements. First off, I welcome your questions. Our mailbag is so much fun to go through. It's great to hear from you and what you're running into as you are trying to analyze the markets using technical analysis. Shoot us an email with any questions that are coming up. thefinalbar@stockcharts.com. Tag us in a comment on Twitter @finalbarsctv. And of course, on our YouTube channel, take a moment and subscribe to it. Why don't you? But also put a comment below the video you're watching. We would love to hear from you. We very much are interested in your questions, and we'll hope to answer your question on our next mailbag segment on Friday's show of this week. Also, just as a reminder, I'll be speaking at the Money Show. If you go to stockcharts.com/Money Show, you can find more information about the events coming up next week in Las Vegas. I'm excited to speak with people like Larry Williams, Tom DeMark, John Bollinger, and others. It'd be great to reconnect with some of those mentors of mine and also share some words of wisdom with all of you. I'm going to be doing 2 sessions. One will be a 30-minute quick intro on top charts that I'll be looking at between now and year end, and also a 2-hour premium masterclass where I'll share my technical analysis checklist that I use when I'm analyzing a stock or an ETF for the first time. You can sign up for those events at stockcharts.com/Money Show, and I hope to see you next week in Las Vegas. All right, I want to bring on today's guest, Jay Woods. Jay is the Chief Global Strategist at Freedom Capital Markets, coming to us from the floor of the New York Stock Exchange. Jay, how are you? Are you still doing okay after today's carnage on the floor?
Yes, I was just reading the headlines about the big plunge today. It's the first day down over 1% in the S&P 500 in over 2 months. The big spike. Oh my gosh, run for the hills, run for the hills. But no, we're okay down here to answer your question.
Glad to see we're still thriving there on the floor of the exchange. It's good to see you. Thanks for coming on. On a day like today, I think a lot of people just struggle with how to make sense of what we saw today. A lot of stocks that had looked pretty constructive, all of a sudden dropping and trying to put it into context. And I think who better than you to help people understand the appropriate way of thinking of a day like today. We're looking at your chart of the S&P 500 to start, Jay, and looking at just the daily movements. What happened today, and how does that fit into your overall perspective of the markets here?
Yeah, I kept this one very simple. I should have had a Fibonacci retracement level like you did on the Qs, because guess where we go? We go to 4,200, which is a major support level here. But I'd like to keep it simple for a reason. Let's just keep it in perspective. I know it's never fun to go through a day where you see, oh my gosh, the trend is changing, something happened, this isn't good. But this is something we're prepared for. The S&P 500 does correct on average 3 times a year, 5%. It happened February, March. I think we're about to have another correction of 5%. And guess what happens if we go down 5%? It's not the end of the world. It's probably a good buying opportunity. It will be right at the rising 50-day moving average, just slightly below it. It should find some nice support there if we do get there. And if it does break a little bit lower, that 43.25 level, which was the old August high, that should act as support. And then, God willing, if it does get a little more aggressive, I think 4,200, which is a Fibonacci retracement level, and also that level we talked about when we were trying to break through to the upside this summer, May, June, that should be a nice support area and a landing spot if it does get out of control, which I really don't think it will.
I think for a lot of investors, Jay, we want to experience all of the upside and none of the downside. And what we have to remember is even a long-term uptrend is going to have its sort of its pullbacks, and those can often be some of the more constructive developments over time for the trend. That's a great point. One sector we've been thinking about a lot recently is energy. Crude oil prices have really started to improve. Your chart of the XLE showing sort of this rounding bottoming pattern. What do you think of energy here, and does today change that perspective at all?
It doesn't change it, but it gives me a little pause. And what we want to do is always set things up risk, reward, risk, reward. That's how technical analysis has made me, given me a career down here at the New York Stock Exchange for over 30 years. This has been the most frustrating sector of all. It was the number one sector in 2021, 2022. It's nice to see the rotation, nice to see it lag. But guess what? In July, it was the best sector. It was up 7%. And I'm seeing a lot of nice signs out of the XLE. First of all, there are 23 components within the index. Of those 23, before I came on the air about 2 hours ago, I did a little research. 100% of those 23 are above the 200-day moving average. That's healthy. And then above the 50, it was 78%. And then let's focus on two stocks in this sector, because guess what? It's two stocks. It's Chevron, it's ExxonMobil. That's 39%. They have yet to eclipse that 50-day moving average. They're lagging this, and they're starting to show signs of life, showing, constructive bases. Not ready to go. A day like today gives me a little bit of pause because we didn't get that follow through, didn't get that breakout. But on an RSI basis, the sector was overbought. We are going to see a little bit of a pull. I forgot to add it onto our great chart there, but I do like the setup with the rounded base. And I'm sick of being wrong in the Occidental Petroleums of the world, seeing that rounded top and it just doesn't crack. And now something seems to have changed. And now let's look under the surface. Let's focus on Chevron. I brought along a chart of Chevron for you. Here's a chart that continues to be constructive, but it's constructive under its 200-day moving average, under its 200-day. I don't like that, but near term, it broke a nice little downtrend. It's holding above its 50-day moving average, and each time it goes down, it's not fun, it's not exciting, but it's making a higher low, and it's lagging the sector itself. And then if you want to put in seasonal factors, forget the August-September seasonal factor. What's happening in the Gulf of Mexico right now? The water is at an outrageous temperature. It's hurricane season. They're predicting carnage down there. No offense to the people in the Gulf. But if hurricane season does start to spark itself up, crude oil is going to rally. 83.5 is the level I'm watching in crude. We break out above that, you're going to see a quick, fast move. Clearly to 71 here, which was the nearest resistance level, but it could spike rather quickly as people move back into the energy sector. So this is one I have an eye on. It's not an aggressive play right now, but it's something to keep an eye on. And risk reward, I think the setup is favorable for actually a leg higher in energy again.
It's so interesting because energy is one of those sectors that has been, just underperforming. It's one of those that's been struggling. But as you mentioned, July, a pretty impressive month. What would you need to see? We have your chart of Chevron up here. And by the way, we just got back from a week in Orlando. I would 100% agree. It was bath water at best was the temperature of the water. It was like it was boiling almost. It was so warm down there. But what do you need to see? I mean, the energy sector, as with many, so top heavy. You have the two integrateds, Exxon and Chevron at the top. What would you need to see on a chart of Chevron to turn really constructive? Is it getting above the 200-day, or is there something else you would need to see?
There are two things. I think the price of crude. Today we took a step back. You can blame the little event that we had with the Fitch downgrade. But I think it has been knocking on a door to break out. I did not bring that chart with me. But if you look at crude above 83.5, you could have a nice pocket fill and a run to, 85 without a question, 90. And that will get those two behemoths to start to move. Other than that, Chevron, yes, break above the 200-day moving average. I think you'll see momentum into it. It's one of a few in the sector that's not above it. I think it's just a matter of time.
Let's continue on here. Last name is Match, MTCH. Of course, as with many, kind of getting a bit of a drop today. But overall, what's the take on this chart and how it's evolved here?
Yeah, Match, the maker of Tinder and Match.com. I was in love with this stock when I looked at it before the Fitch downgrade. And you know what? I scratched my head a little bit and I backed it out, and we're going to talk about that. And I still like it. The risk reward setup is there. I would have liked the follow through on a gap open and follow through today. It did not happen. It failed. But watch the 44 level. If you're going to get in this name, you can get in now, but keep the stops close. Keep them nearby, because if it breaks 44, we're going back to the 200-day moving average, and maybe the trend has changed. But let's look on a bigger term. Let's go back 3 years. This is one of those classic stocks that was a darling during the COVID crisis. And, people broken up with it. But now it's time to mend those fences, and I think the relationship could be strong over the long term. As we have broken out, if you like lagging indicators, I give you a potential golden cross. It's there set up for us right now. I don't like to predict that it's going to happen, but I'm fairly certain we may be seeing it here. It has a lot to reverse. So the downtrend's been broken. It had a constructive bottom. It is breaking above some key moving averages. Today's earnings, I think, was overshadowed more by the Fitch downgrade. So that 44 level is definitely something to watch. But if it holds, it gets a few upgrades after its fantastic earnings report, then I think 52, 55 is an easy step in the stock. In fact, it was trading 52 after hours before the downgrade.
It's amazing how this sort of name, these are some of these like COVID era names that it did so well out of the, in 2020, and then all of a sudden rotated lower. You're really starting to see a rotation, more of an accumulation phase. It's impressive how that is really begun to happen. Thanks for highlighting that on your 3-year chart. Jay, listen, if I could ask you, it's so cool to talk to you on a day like today. Can you share with us just words of wisdom of how you deal with things when you go into go into the trading day, probably having one idea of what's going to happen, and then this sort of black swan event comes up and completely changes the narrative. What do you do to sort of regroup and prepare for what's to come next on a day like today?
I back it out, just like I did with that Match.com chart. One, I may throw something across the room in frustration, but that's just a me thing. But two, no, you have to keep a cool head. You have to have a game plan, and you have to adapt. And that's why technicians like yourself, like the great people you're seeing at the Money Show, I'm sorry I missed my invite to that, but I can't wait to log on Stock Charts and watch you guys. That is why the trade has kept me afloat for so long. You have to be adaptable. You have to adjust. And that's why I kept Match.com as one of my picks, because it did change and it did throw off my thesis, because it was supposed to gap today and follow through. It didn't. So now what's my next plan of attack? I will enter the stock here, around the 44.5, 45 level, or if it can gap up tomorrow, I'll chase it. I'm not afraid of that, because I think the setup is still there. But you always have to be adaptable in these markets, and stop orders are the most important thing to any short-term trader. And then long-term traders, you want to have a trailing stop. You were going to talk about Apple tomorrow. That's going to be the most interesting earnings we're going to see in a while. I remember, Microsoft just last week. I'm old enough to remember just last week, Microsoft, how they had a great quarter, but guess what? The stock has sold off pretty tremendously since then. Nothing out of the ordinary over a long-term basis. So if you back out and you see where it's come from, just like you backed out the Qs before I came on, I think that is the way you have to do it. Put these things in perspective. If you're a long-term investor, it's okay. If you're a short-term investor and you're looking for a quick play, use your stops.
Jay, that was very well said. I appreciate your words of wisdom and help for investors to try and process a day like today, how to put it into proper perspective. Thanks for joining us from the floor. Best to you and everyone around you there, and we'll talk to you again soon, Jay.
Always great being with you. Thanks, Dave.
It's Jay Woods. Jay's the Chief Global Strategist at Freedom Capital Markets. What a pleasure to talk to someone like Jay. He's had an incredible experience, incredible career on the floor of the exchange on how to deal with a day like today. I find a lot of times investors get very caught up into a particular narrative, particularly around our positions, right? I own Apple, so I'm now willing Apple to go higher and higher, and I sort of have this idea of how this trade is going to work. So, well, sometimes days like this happen. And if you look at market history, you will find more often than not these crazy, unusual, in some ways unpredictable events happen. But that's why the technical analysis discipline is embedded in things like risk versus reward, thinking about downside potential versus upside potential, and accepting days like today as a risk, an acceptable risk for the opportunity for further upside. Great take there, and what great investment wisdom from Jay Woods at Freedom Capital Markets. Folks, we have to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We talked about the Nasdaq 100. I showed you a quick Fibonacci analysis thinking about downside potential if we get further move to the downside after this today's sort of quick breakdown. One of the things that I like to do is look at my market trend model, which by definition looks at the S&P 500. That's the main benchmark that I'm trying to understand and track and quantify. However, I also run my market trend model on a bunch of other things, on small caps and mid caps and the Nasdaq and other global indexes and other ETFs as well. And when I'm looking at the market trend model using the Qs, you'll note that if today was Friday, because I don't update it until every Friday at the close, but if the end of the week was today, and if today, Wednesday, was Friday's close, the short-term model would turn negative. What's interesting about a day like today is it's pushing things down below potential support levels, below some of those key short-term levels, which may indicate to us that a market may be still in an uptrend. So the fact that the market trend model may turn negative on the short-term basis for me on Friday for the Qs would be one of those potential red flags telling you that this brilliant rally driven by growth may be on a big pause button. Chart number 2 is the Nasdaq 100 bullish percent index. I had a great discussion with a number of people earlier today, some media outlets about breadth, particularly looking at breadth conditions. The reality is the market breadth has been incredibly strong. It was not as strong in the first half of 2023 because it was a narrow leadership environment. You had the FANG stocks like Microsoft and Apple doing very well, while the average stock was sort of languishing, not having a great year. That's changed. June, July, you started to see a lot of those names that have been struggling start to improve. When sectors like energy and financial start to rally off of their lows, that creates some more of a positive breadth twist. The problem is breadth then became excessive until today, and I think the Nasdaq 100 bullish percent index today getting back below 70%. We'll see what happens through the remainder of this week. We've got a lot of earnings coming up Thursday and Friday, a lot of earnings to process again today after the close. But once all is said and done, if we end this week with the Nasdaq bullish percent below 70%, it looks a lot like these red shaded areas that I've highlighted before, which is when the bullish percent index became excessive and then came back below that extreme level. That pretty much picks out all the major pullbacks. Jay Woods, my guest today, was talking about a 5% drop in the Nasdaq 100. I don't think that's an unrealistic downside objective as well. I would say that's completely realistic and actually quite common even during a bullish phase for stocks. Finally, energy. When I'm looking at DVN, which is one of the many energy names reporting this week, take a quick Fibonacci framework. The October high, which was just around 75, just below $75 a share. The March low, just below 44. We can see that first rally March into April was right to that 38.2% level, right around 55.60. Look at how well that coincides with the 200-day moving average. So my general way of thinking of a chart like DVN, is there a higher low? There is. In May and June, we put in higher lows. We even put a higher low in at the end of June, early July. But from there, we haven't quite gotten above that first Fibonacci level. And that often serves as a resistance point. We tested that in April and failed, so 55, 60, 57, 56 would be a key level of resistance. And until we get through there, the chart of DVN, while rallying in the short term, is not getting enough upside momentum. Today's drop over 7%, putting a big question mark on whether the energy sector can follow through. We've traded to resistance, but not quite enough through resistance. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. A special thank you to Jay Woods of Freedom Capital Markets joining us from the floor of the New York Stock Exchange. Don't forget to join me at the Money Show next week, stockcharts.com/moneyshow for more info. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. See you tomorrow.